With manufacturing moving into expansion territory and unemployment steady at 4%, the Federal Reserve faces a major dilemma. Can they afford to cut rates without reigniting inflation? The latest Consumer Price Index report shows that inflation rose 0.5% in January, with the 12-month rate now at 3%. Core inflation, excluding volatile food and energy, also increased 0.4%, reinforcing concerns that inflationary pressures are far from under control. At the same time, the ISM manufacturing PMI rose to 50.9%, signaling the sector has returned to expansion for the first time in over 2 years. Typically, an improving manufacturing sector supports wage growth, which could further fuel inflation, the very issue the Fed has been trying to contain. For months, markets have anticipated that the Fed will cut rates in 2025, but the latest data complicates that outlook. Here's why. Unemployment at 4% shows no urgency for cuts. Historically, the Fed only aggressively cuts rates when unemployment spikes. At 4%, the labor market remains stable. Wage growth is still running at 4.1% year over year, supporting consumer spending, another potential inflation driver. Manufacturing is expanding, but at what cost? While job losses in manufacturing continue, new orders and production are surging, possibly due to companies front-loading activity before future economic uncertainty. If manufacturers ramp up production while the Fed keeps rates high, businesses will pass increased costs to consumers, keeping inflation stubbornly elevated. CPI pressures suggest inflation is not done yet. Shelter costs rose 0.4% in January, and still account for nearly 30% of total inflation. Energy prices jumped 1.1%, driven by gasoline's 1.8% increase, a sign that volatile costs could continue to push inflation upward. Key services like motor vehicle insurance, up 2%, and transportation services, up 1.8%, remain sticky, meaning the inflation battle is far from over. The endgame: no cuts, higher inflation? If the Fed holds rates steady for too long, the economy could stall out completely. However, if they cut too soon, inflation could accelerate once again, a repeat of past policy missteps. Right now, with the economy still growing and CPI still rising, there's little justification for immediate rate cuts. The Fed may be trapped by its own policies, unable to ease without risking an inflation resurgence, yet unable to tighten further without stalling growth. So the real question is, how long can the Fed hold off before either inflation forces their hand, or the economy starts cracking under high interest rates?